All right. Well, we're going to get started here. I guess first and foremost, Happy New Year. Welcome to 2026. I think this will be one of the last days of mentioning Happy New Year. It's hard to believe we're already almost 2 weeks into this new calendar year, and it's definitely entered with a bang. A little bit more of what we saw last year in terms of economic and geopolitical news. So what we'll do today, I'll spend maybe half an hour to 40 minutes chatting about some comments as we head into the first quarter of the year. Before I jump into it, I do encourage anybody that has any questions at the bottom of your screen. If you hover over it, you'll get a ribbon that comes up, and on there it'll say Q&A. You can click that and you can type in any questions. I'll try and actually answer them perhaps throughout the session, or generally what I'll do is I'll do it at the end. In any case, if I don't get to them all, I'll try and send emails with my comments thereafter. So with that, let's actually get started here. So today, what we're going to talk a little bit about is what do current markets mean for you. We've been chatting a lot about this. Obviously, we remain cautiously optimistic going into this year. I'll talk a little bit about that in the first couple of slides. Chat a little bit about income strategy, cash flow. Just go back and revisit some content that I did last year about taxation and understanding it. I think it's even more imperative today that if we have cash that's sitting on the sidelines that perhaps is just an interest-bearing investments, if it's carved out for something specific, no problem. But if you're investing it from a GIC or an interest rate environment, as the Bank of Canada has reduced rates, obviously the yield doesn't outpace inflation today. And then lastly, again, I'm going to combine this, but taxes are finally undermining your progress. So I'll combine those two together. Okay. So first thing I'm going to start with is just this renewed commentary about this thing you likely are hearing either on the news or in media in general about this K-shaped economy. And I came across this cartoon. I kind of liked it. Obviously, the wealthy are getting wealthier, and the folks that are on the bottom, you can see what this says with the screw. But that's essentially what's happening. For a lot of folks, they say, hey, the economy is doing well or the markets are doing well. But the underlying economy is not telling the same story. And so what I mean by that, the next couple slides here, what we've seen in the markets are the wealthier individuals that have money in the markets are benefiting from these strong gains that we've seen over the last 2 to 3 years. But unfortunately for those at the bottom end of the economy, renters in hospitality, retail, non-college grads, so on and so forth, these are ones that aren't having the opportunity to have the wealth in the markets to participate. So unfortunately for them, their day-to-day expenses are increasing due to inflation, trade policies, and so on. So we're seeing a significant gap between the top end of demographics and the bottom end. And so when we look at the graph here on the left, which I thought was really interesting, when you actually look in the terms of whether it's corporate equities or mutual funds that are held in the US based on millions of dollars, what's really interesting is when you look at the bottom 50% of the general public that invest, you can see that it's signified by the red here. It doesn't even show up. It's insignificant. And you can see the wealth, over the last 3 to 5 years in the top 10% of the demographics, we can see there's been a substantial gain. So this is what we're seeing. We're seeing a significant amount of wealth disparity. And I believe this will continue throughout 2026. So when we look at the markets and we say, hey, how are we positioned for the year? What do we think is going to happen as we head into 2026? Notwithstanding some of the news that's coming out, obviously with Venezuela, we're hearing about Iran. You'll always see this geopolitical risk. It was the trending story or topic we've seen since the U.S. administration changed, early last year, and this is happening on a fairly regular basis. And so what's happening, we're seeing in the markets that despite we get these media-driven stories, it's not impacting the market the same way as what maybe it would have a year to a year and a half ago. So when we look at Canada and, hey, how are we positioned this year? When we look at the trade policies out of the US, obviously it's really unnerving. He came out again. Trump came out yesterday and talked about, or 2 days ago, and talked about tariffs, increasing tariffs for countries that deal with Iran, an additional 25% in tariffs. When we look from a Canadian point of view, we are still one of the lowest countries in the world when it comes to tariffs. Okay, 86% of our exports to the US would still continue to be considered duty-free. Okay. So again, yes, our tariffs are higher than what they were, but they remain below 10%. Canada had a really good year last year in terms from an economic point of view. Our markets did actually quite well. But again, given the fact that they've been reducing rates, the Bank of Canada, tariffs not having a dramatic impact from an economic point of view, things were quite good. And that being said, I've said this often, if you go to the grocery store, cost of goods and services, they are higher than what they were, despite what things are telling us. And you go in, and again, I say it all the time, you get less and less in your bag when you leave the grocery store. And this is a phenomenon that I think will continue. And again, this is when you talk about that K-shaped economy. These are really what's impacting the lower end of the demographics. So what Canada's been doing, obviously, we had a new budget that came out last year. And really, they're looking at Trump-proofing the economy. Carney is in Asia right now doing a trade trip. Really, they're focusing on trying to Trump-proof the economy. And so what they're looking at doing is, again, they're adding money into infrastructure and so on, and they're looking to actually see some significant growth by expanding our trade relations outside of the U.S. And I just saw an article yesterday, or a statistic, which was really interesting. I talked about China's trade surplus. They have one of the largest trade surpluses the world has ever seen in 2025, which is really unusual given the fact that the tariffs that were applied to China and obviously surrounding countries were very significant. But they actually had one of the largest trade surpluses because they're shipping and exporting to a lot of different countries outside of the US. So despite the noise, economies are doing surprisingly well, and they've been resilient. So let's just switch gears again. Just what we think are supporting reasons why we're cautiously optimistic this year. So again, you've seen this slide, interest rate outlook. In Bank of Canada, here, Bank of Canada, we think are in the end stages of their rate cuts. We don't see many more cuts throughout the year. I think what we see is what we get today, unless things significantly change. Where we see the changes potentially coming from is in the US. So the US, we believe there's still room to cut. That being said, obviously we saw news, I guess it was in the last week or so, with Trump and the US Fed, with Powell. Obviously there's a court case now against them. This is not a positive. It doesn't give a lot of confidence. The US Fed is considered an independent entity from the government. And really where some of those concerns are is this going to get commingled? Will there be more influence, and will there be less autonomy than what there has been in the past? So given what's unfolded, the likelihood of a rate cut by the US Fed on the next meeting is lower than what it was as recently as the beginning of the year. That being said, we do believe it'll continue to cut, and with cheaper money, obviously, it's better for just the general public. It's cheaper to deal with debt. Corporations can borrow at lower rates. Mortgages go down. So anytime we see monetary easing, it's a positive in the economy. So when we look at the PMI, which again, this is the manufacturing numbers. Where we were coming out of 2025 right here, the trend, which is this red line here, we see it as a forecast to be moving more positive. And generally when it's below 50, this data, what it tells us, we're actually in some challenging economic times. But based on how things are unfolding, we actually believe that manufacturing will pick up, which will be a good sign for the economy. Okay. Now in the US, again, I talk often about the US economy rather than Canada. Canada has a very small economy when you think about it from a global point of view. So it makes more sense to look at what's happening in the US, because US really drives global markets in a lot of cases. And we saw that in 2009, 2020, 2022, and so on. So when we actually look at the key drivers of the US economy, again, we expect it to remain stable, driven by AI investments. I have a couple slides on this afterwards. Fed easing and fiscal stimulus. So three key reasons why we think the markets will continue to march forward despite some volatility. Okay. Unfortunately, growth will be tempered by tariffs, reduced immigration, which impacts us here in Canada as well. Obviously, our immigration policy has changed. And we're also starting to see the labor market deteriorate a little bit. They came out with data just a week or two ago about employment numbers out of the US. It was one of the lowest numbers that we've seen in ages. Okay. And that being said, we think unemployment's going to edge up a little bit before it starts to stabilize. So here's where we are today, Q1 2026, from a GDP point of view, we see growth before it may be slowing down and declining more so in a year to a year and a half. So again, reasons to be cautiously optimistic is, again, some of these three key points that I just mentioned on the slide. Another thing that we take note of, and this is something we've talked about over the last couple of quarters, but our earnings forecasts for, obviously big companies. JP Morgan just came out yesterday and announced their last quarter earnings, and they blew it away. Wells Fargo this morning, they missed a little bit, but other financials are coming out with strong results as well. So they're kicking off earnings season, coming out of 2025 into 2026. We see double-digit returns in global economies. If we look in the last 10 years at these various economies and earnings growth, they were all below 10%. So 2025 was good, 2026, even 2027, we see stronger earnings growth than what we have in the last 10 years. And we saw that in the most recent quarter. Over 80% of companies that reported, they either met or exceeded expectation. Historically, that number is around 65%. In the previous quarter, it was in the 70%. So again, we're seeing companies be profitable based on things that they've been doing early in the year, like AI investment and so on. And this is a great segue right to AI implementation. So AI, when you look at, it's really big in its infancy. It's been roughly 3 years since it's really started to come to the forefront. But we're seeing a lot of companies that have invested in the last couple of years, and that investment is starting to come to fruition. They're starting to see those numbers work into their earnings. They're becoming more efficient, more profitable, and so on. And so when we actually look at businesses that use AI in any business function for that matter, we can see it. There's a significant adoption in actually up to 2025. And if we actually look in the next 6 months, which are these gray bars, we can actually see there's going to be extended momentum moving forward. Okay. So it's going kind of from the investment phase into the adoption and implementation. And so when we look at some of those early AI investments, we're starting to see a lot of these companies, it's starting to pay off. Okay. So some of the investments, 2024, 25, and so on, a lot of these big companies, we're actually starting to see the investment in AI as starting to impact their bottom line. They're becoming more profitable and so on and so forth. So again, and I talked about it in my last session, are we in a bubble, an AI bubble? And one of the things that we talked about was, technology and the big companies today are much more well-financed, bigger cash value or cash balances on their bank accounts. They're well-funded, lower debt. They haven't had the same earnings projections and valuations as what we saw in the tech wreck in 2000. So we think, these big companies that are really driving this AI trade, they're much more stable than what they were during the tech wreck of early 2000. And then the piece here that I'll chat about is just the US dollar. People generally are always asking me, hey, what do I think is going to happen with the US and Canadian dollar? I think really what's happening is it's kind of found a nice kind of range right now. I think it's really in a wait and see of what's going to happen with the trade deal, obviously North American trade deal. Challenge is we can actually see it move quite quickly in a short period of time based on things that are coming out of the US, some of their policies and so on. So we will see it, I think, in the short term bounce around a little bit, but it will find that range over the long run. And we think the Canadian dollar will likely appreciate at some point here. All right, so I'm going to pause there. So that's kind of the outlook in Q1. That's the outlook of why we believe 2026 in the markets. I would be happy with a strong single-digit, low double-digit return in the markets. That's where I thought we'd be last year. It far exceeded what our expectation was, even as we went into Q1 with some of those challenges with the U.S. administration, with their trade deals and how they handle some of the geopolitical risks. But overall, the market's actually plugged along. And we believe the same will be true this year, but it will be, obviously, we'll go through periods of ups and downs. We don't think it's going to be, a steady upward climb. It wouldn't surprise me if we go through some periods of contraction, but I do believe fundamentals will likely prevail, and we will see positive markets to close out the year. I know it's 12 months away, but based on how we're entering the year, that's how we believe it'll shape up. And if you remember from my previous session, I think it showed about 8 to 10 different financial institutions that's forecasted where they felt the S&P 500 was going to be. And I think all but one felt it was going to be higher. I think the lowest was about 5%. Some of them had strong double-digit returns. Okay. So talk a little bit about why we invest, folks. Again, this is a good point to go back. I mentioned this right at the very beginning of the session. Interest rates, obviously, in Canada has been slowly declining over the last 12 to 18 months. Today, a one-year GIC gets you around 2.25% to 2.5%. If you're lucky, you might see something over 3% if there's a financial institution that is offering a teaser rate. But generally speaking, we're below 3%. And inflation is trending around 2 to 2.5%. So now what we're at is interest rates and inflation are roughly the same. So this actual chart is a great visualization of your purchasing power over the last, I don't know, what is this, over the last 30 odd years, okay? And if you look at just simple cash and corporate bonds, if you would have invested $10,000 in 1996, your cash would be actually worth less. You would have had a 3% or a 2% loss because of tax and inflation, okay? So as much as we are comfortable with seeing what it looks like in our bank account, it doesn't fluctuate. The ability to buy goods and services, it takes more dollars to do that today. And again, I use the example of, you go to the grocery store today and you're paying more for a jug of milk and vegetables and so on. So you have to do something. So if you just go into corporate bonds, you would have roughly doubled your money over the last 30 years. Doubling your money over the last 30 years would have been roughly maybe a 2% rate of return, 2.5% rate of return total. So not overly great. When you go into equities, small cap, large cap, we can see the outcome is much better than if you just use simple cash. But that being said, if you go back to these ones, very little volatility, to generate growth within your actual dollars, you would have had to go through some periods of contraction. But again, if you have a mid to long-term time frame, and generally when I say mid to long-term, I think of it in a cycle or in a market cycle more than 20, 30 years. If you have the ability to stomach that ups and downs and use a combination of large cap, cash flow investments, alternative investments, maybe even a little bit of fixed income, I think you can actually have a really good result with below average risk, which is what we've done for you over the years. Okay. So just talking a little bit about tax, how income is taxed. Again, this is the slide that I've shown at different times throughout the last 18 months, but a good one to kind of review. Again, if you look at interest income, this is based if you're in a 53.5% tax bracket. I know a lot of you on this call might say, I'm only in a 40%, a 30%. It's okay. It's all proportionate. So if you're in a 40% tax bracket, the difference will be the same. It'll just be on a prorated basis. So if we look at BC on interest income that you receive, so on a GIC, if you receive it on a bond, if you have a mortgage or what have you, for every dollar you receive, if you're in a 53.5% tax bracket, you're giving away 53.5 cents and you're keeping, 46.5 cents in your pocket. Okay. So on $100,000 of interest income, you're only keeping 46,500. Okay. That's what you keep. The government actually earns more on your interest income than what you get to keep. Okay. Now we look at capital gains, the far right column. Well, capital gains are taxed at half the amount. So what that means is if you have a gain of 100,000, only half of that 100,000 is taxed. So $50,000, and then 50,000 at your marginal tax bracket of 53.5%. So on 100,000, you're paying the government roughly $27,000, and you're getting to keep roughly 73,000. So you're effectively, if you look at the difference between these two investments, you're effectively keeping, what is that, 60% more in your pocket than what you were in interest income, give or take. Okay. Now, dividends, what you get from a lot of our Canadian companies, whether it's utility companies like Fortis or so on, Canadian Utilities, our banks, any of the big six banks and so on, you can receive dividends, and dividends are taxed in between. So again, on $100,000 of dividends, you're keeping in your pocket $63,460 versus if you have interest income of $47,000. Okay. Now, with investments that pay you dividends or capital gains, yes, there could be some fluctuations, but as I showed in my previous graph, that volatility leads to better returns. So I believe we're at a crossroads right now for folks that are sitting on cash, that have been sitting on cash because when interest rates were paying 5-6% back in 2022, 2023, I think 2026 is the year that you need to address it and get that money working differently for you. Because again, the purchasing power of that money is declining, even if you don't see it in your bank account. Okay. Now somebody asked me about if you guys could see me. I don't actually see myself here. So what we'll do is I'm just going to stop my video. We'll try it again. Let's see. Yeah, my video, I don't know why isn't working, guys, but hopefully you guys can still hear me. If you can, just type into the question Q&A and just say, yeah, I can still hear you. So now just moving on here from the income piece, let's move to the next one. Bear with me. So return of capital. So I talked about interest income, dividend income, and capital gains. Okay. And I got it perfect. I see videos working on your end. Awesome. Perfect. Thank you. For whatever reason, I don't see it on my computer. So return of capital is another distribution that we can receive as investors. Okay. Now, how return of capital work? It's taxed similar to capital gains. Okay. But you don't get taxed in the year you receive it, but rather you get taxed in the year that you sell the investment. Okay. So biggest thing is that actually is very tax efficient. Okay. You get to keep all your money today rather than paying tax along the way. It also provides some cash flow stability. I'm going to give you an example here in 1 second. Allows you to tax defer the tax payments in the future. And one thing that I really like is it actually gives you the ability to utilize capital losses. So for some of you, like we do a tax loss project at the end of every year, and we will trigger paper losses by selling from one investment to the other. And that paper loss, which is just something that gets categorized on your tax return, is something you can carry forward forever. And when you have future capital gains, whether when you sell or from return of capital, you can actually deduct those capital losses against this return of capital or capital gains, and you reduce those taxes. Okay. So there's a lot of benefits for these. So there's actually 4 distributions that we like. And in the order would be capital gains and return of capital, because they're only taxed at 50%. Return of capital, you defer for a longer period of time, and then dividends, and then interest income in terms of what we like as being the most tax efficient. Okay. So let's actually look at an example. Lots of information on the slide, so I'll try and simplify it here. Okay. So these are 3 examples. One is income that you're receiving from an interest growth. One is dividends, and one is investment with return of capital. Okay. Now, how this works, this is over a 25-year period at 6%, investing $100,000. Okay. So if you invest in interest income, the reason why you see these little jagged marks on the first 2 lines is because it's factoring in the tax that you have to remit every year when you earn this income. So let me give you an example. Do you know when you guys get T-slips at the end of every year, you have to submit those to your accountants or when you do your return, and you got to pay tax on that income that you're receiving over the years. Okay. So it effectively reduces your return by whatever amount you're paying in tax. So what these 2 show is every year when you're remitting the tax, on 6% interest income or 6% dividends. So what happens is these grow. The interest income at 6% grows to 233,000. Dividends, they grow to 318,000. Okay. Return to capital, you don't really pay tax along the way, but when you sell in the future, that's when you pay the capital gains. Okay. So you pay the tax all in one shot. Okay. But you're left with 370,000 on your initial $100,000 investment versus 318 or 233. So it's not as though you're taking more risk, because you can buy bond or fixed income investments that actually pay you return of capital distributions, but you're actually left, in this case, you're left with almost $40,000 more, excuse me, or about 65% more money in your pocket because you've managed the tax along the way versus just simply buying interest-bearing or dividend-paying investments, okay? Now, when we look at it from one more point of view, from a cash flow perspective, again, lots of numbers on here. So again, I'll try and simplify it. So if you were to invest $500,000, $500,000 at 6%, same thing as before. 6% on $500,000 is $30,000 a year, or $2,500 a month. Okay, hopefully that makes sense. I'll let that sink in for a sec. Well, if you're in roughly a 45 to 50% tax bracket, in order to put $2,500 in your pocket after tax, you effectively have to earn 11.2% on that $500,000 to net out $2,500 if it's an interest-bearing investment. Okay. Now, if it's a dividend-paying investment, I taught you a few slides ago, you pay lower tax on dividends. Well, the effective rate of return you would need to earn on $500,000 to put $2,500 a month in your pocket is the equivalent of 8.5%. Okay. Now, again, if you use, a corporate class or something that actually pays out return to capital, I said to you earlier, the money that you receive in your pocket in that year, you do not pay tax on until the future. So the effective rate of return you need to generate in that year on $500,000 is 6%. Because when you receive it, you don't pay tax. You pay tax in the future. So just by managing the tax consequences of your investments, you can actually take less risk and put more money in your pocket, as opposed to just utilizing securities that are paying high tax distribution. Again, these are things that are often overlooked. This is things that we look at. How do we minimize tax? By how we place the securities in different accounts, or how do we manage tax based on some of the underlying tax treatments of your distributions? Okay. All right, last couple of slides here. I mentioned I'd talk for 30, 35 minutes before I answer some questions. So if you do have questions, now is the time to put them in, but we have quite a few that are coming out here. So again, please put it in and I'll try and do my best to answer as many as possible. So last couple. So again, going back, a lot of Canadians invest in two asset classes, okay? Stocks and bonds. 2022 and 23, people added cash simply because interest rates were higher. So one of the things that we've been educating our clients and our families about over the last number of years is actually investing in 6 asset classes versus 2. And what I mean by that is, beyond traditional stocks and bonds, there's private real estate, private credit, private infrastructure, private equity, that generally speaking are not accessible for the general public, okay? Here at Harbourfront, obviously we have access vehicles where investors can get access to it, but generally speaking, we see these types of investments in pension plans, institutional money managers, endowment funds, charitable foundations, and so on, where if you look at the CPP, 60% of how they invest is in these other asset classes. Okay, Ontario Teacher Pension Plan invests mostly in these different asset classes. So if the smart money knows that the returns that they're getting on these alternative asset classes are both more predictable, have lower risk, lower standard deviation, then why don't we have access to it? Okay, the reason why is we live, again, in Canada. It's a very narrow financial market, mostly driven by the 6 big banks. They generally are very narrow in what they offer. Mutual funds, maybe ETFs. Banks don't generally offer stocks unless you go to their wealth managers or their brokerage houses. But generally speaking, they have mutual funds, okay, stocks and bonds. So when we look at actual U.S. companies that are around down south, look at the amount of public companies versus private companies. And these private companies, I think about globally, companies like Lego and Rolex, these are all private companies. I can go on and on about different private companies that are out there employing individuals, they're profitable, but the problem is you and I can't invest in them. Okay. So there are ways to access some of these private companies through different structures. So again, when we look at private companies, what is that? There's 6 times more private companies than there is public companies. And when you look at the, 500,000 to 1 billion, there's way more here than there is in the public. Okay. And this is what the big endowment funds have actually learned over the years. All right. So how do we get here? Why all of a sudden have we seen the CPP over the last 20 odd years shift a lot of what they invest into the alternative space versus the public space? Well, if we actually look at the chart on the left here, here's the global financial crisis in 08 and 09. Okay. And what we saw is a lot of banks that we saw consolidation with, but a lot of banks learned and they said, hey, there's going to be more stringent rules in place for us to lend capital, and they become more conservative. And what we've actually seen over the last, 16, 17 years since the great financial crisis, we've actually seen bank lending both in the US and Canada, it's declined. Okay. They're more conservative. Think about it. If you go in and get a mortgage today, it's harder to get a mortgage today than what it was 10 years ago. Okay. My mother-in-law, I've told this story before. She downsized a property, 7-figure property. She sold it. She had a bill of sale. It was signed, and she was buying a condo. She was downsizing. She went to the bank and they would not give her a loan, a mortgage in the short term, bridge financing. And the reason they wouldn't give it to her is because she's a retiree living on a small pension, just simply because she doesn't have a lot of expenses. So she had assets, but her income was low. And so when the bank looked at it, they just said, listen, we're not going to lend to you because your actual income is low. So they didn't just look at one or the other, they look at both. Okay. And I have other stories where we have business owners, same thing, that have gone to one of the big 6 banks and they will not get lending for a mortgage for a rental property simply because they keep their income low. And this is common. Okay. So as this is declined, as lending has been on the decline over the last 17 years, the global private space has actually increased. They've had to pick up the slack. And the reason why is because there's still private companies that are acquiring other companies, they're investing, they still need to access money to build their businesses. It doesn't mean that they're overly leveraged. It just, instead of getting money or lending from a bank, they're now getting it from, the alternative space. Well, these companies have now also been able to say, hey, we actually have a portfolio of loans or agreements with top class companies or what have you. We can make some money. You can tap into that and you can actually get investments in some of these spaces. And that's where, private credit, private real estate type investments have benefited our clients. Okay. So this is how we've trended. This is what's happening in the real markets. The benefit here at Harbourfront, we have access to this for most of the people on this call. We do own the 1 to 2 asset classes that most Canadians own, but we also have access to these other 4 asset classes. So you truly get great diversification. And I think that's key. When we actually look at diversification, it does matter. Okay. So these are just some of the portfolio managers a number of you have in your portfolio today. Unfortunately, you don't see them on the statement because you just see a line item. You might see Foresight Private Real Estate, or you might see Jackson North American Equity Pool. But these are the types of companies that are managing those pools, and they're top notch. Arrow Street is out of Boston. Unfortunately, I cannot invest our families in Arrow Street directly because they only manage institutional money management. So they want at least 80 to 100 million to even consider working with a company. So what we can do within the pools is our portfolio managers, our office of the CIO, Chief Investment Officer, they can go to a company like Arrow Street and say, hey, we would like you to manage a piece of the portfolio that we're investing in. And Arrow Street, with a lot of due diligence, might say, yep, we're open-minded to it. They go through the due diligence and they look at them on a regular basis. Okay. Leith Wheeler is another one. Leith Wheeler and Connor Clark on Lund. They're both here in Vancouver. Really reputable firms, Canadian equity type money managers. But again, we can't access those directly, but we can actually have them manage pieces of the portfolio on behalf of our clients. JP Morgan's another one. Is another one. Hamilton Lane. These are all top-notch, big, large companies that are in the majority of our portfolios in one way or another. So diversification, I think, is key, especially at the beginning when I said, hey, we have some of these geopolitical risks. You know, we have some things that we're recognizing. We could have some headwinds despite the positives, but by diversifying our approach, we actually increase the likelihood of our clients and families having a good result. Okay. And this is my last slide, guys, and then I'll actually circle back. So this is one that I've talked about in the past. I should have actually circled last year. What this slide shows us is intra-year declines in the market. So the bottom, so what you see down here, all these red little dots, this is the decline that the market has had throughout the year. These gray bars, this is what the market did for the year. So what it posted. So this is the S&P 500. So here's an example. Last year, the S&P 500 posted a 16% rate of return. Okay. But at one point, which was in March and April, it was actually down 20%. And at a 20% decline, if you remember when Trump came out, he took office, and then he announced the trade tariffs. He came out and he said, hey, I want Canada as my 51st state. I want Greenland. I want all these things. Markets reacted quite quickly. And the S&P 500 actually was down 20%. NASDAQ actually hit a negative below 20%. Okay. Now, despite that, the markets were up 16% by the end of the year. Okay. The same is true when you look at some of these other ones. So even if you look at, 22, markets were down as much as 25%. S&P finished down 19%. In the years of recovery, again, we saw drawdowns of double-digit returns in a lot of the years over the last decade, but markets, S&P 500 finished positive. So this is a good reminder that discipline and perspective is key, guys. That's why I said at the beginning, what do we think is going to happen? What's the data telling us? There's a lot of reasons why we think we should be cautiously optimistic with AI, earnings season, fiscal policy, and so on. But that being said, we will go through periods of contraction. It's not an exception. It's a norm. So when we go through this, like I said, just be mindful of it. The people that are the most disciplined, especially last year, were the ones that did the best. Okay. And I've looked at that through last year's returns. Pretty much all of our clients stayed the course because we invest based on expected volatility. We try and design the portfolio based on your current risk tolerance and what you're trying to accomplish. And overall, like I said, we get good results from it because again, we take the time and do the planning about how we approach the portfolio management based on the data that we have ahead of us. Okay. So that's where I'm going to wrap up there, guys. I'm going to turn it over with questions. I have a couple of them here. So I have here, how do you know in advance of share purchase the likelihood of return to capital? Are there specific investments that tell you? So I have a question here that says, how do you know how much return to capital you're going to receive? So a lot of times the structure of the investment, we know what kind of distributions we're going to receive. If it's a specific return of capital investment, it's structured to provide return to capital. So we know the full distribution is going to be return to capital. Okay. Now there's other investments that have distribution. So as an example, Foresight private equity or not equity, private real estate and infrastructure, we know about 70 to 80% of that distribution that they have throughout the year, which is anywhere between 5 to 6%, is generally categorized as return to capital. So we do have an idea about which ones will be return to capital and which ones won't be. Some will be variable, some will be more fixed. So the answer to that is yes, we understand, because again, a lot of times it's how it's structured at the time when the investment is put together. Okay. What else do I have? I have a lot of people saying, hey, video is working. We can see you, which is fantastic. Thank you so much. So I have a couple other, one person has actually a specific question about tax season, which is good. So tax season, I didn't put anything in here because we'll likely do another session in February. But for those of you that are eager to file, generally your tax packages will start coming out at the beginning of February. And when I say tax packages, I don't mean T-slips. Some T-slips will come out, but generally Harbourfront and National Bank will send out tax packages, income summaries, and so on. That'll be your first package. But then the T-slips, tax slips that come out, they're generally generated by the financial institutions where you've invested. Unfortunately, guys, CRA mandates that these come out by the end of March. So because of that, you're going to see T-slips anywhere from mid-February all the way up to the end of March. So for some of you that are looking to file quicker than later, just be mindful that you might go to the accountant and file. You could have some T-slips that trickle in after you've gone if you go too early. So I would just be patient. This is not unique to Harbourfront. This is the reality of our tax system in Canada. I don't know why CRA has an end of March date for them to get mailed to you. It would be nice if they'd move it up, because by the time they mail it, you might get it in the second week of April, and then you got to file by the end of April. So they don't give you a lot of time. But generally speaking, most of these will be out, hopefully in March. But like I said, just be somewhat patient with it in general. Okay. I have one other question here as well. Yeah, how does the recent geopolitical events they've said, how does it impact markets? I mentioned it earlier quickly about Venezuela, and I wrote in my commentary last Friday about the nuances of Venezuela, what it means to North American markets. Obviously, the big one is oil. How will that impact the U.S.? How will that impact Canada? One of the things that we're learning, obviously, is there's a lot of reluctance for U.S. companies to go down there and actually manufacture or to do business down there, just from a safety point of view. So even if it does shake out where we see Venezuelan oil come in through North America, I think it'll take a little while. I don't think it'll disrupt it too significantly at this stage until we see things that are a little bit more concrete. And it's a situation that we're still learning about. It's the administration out of the U.S. Have quickly moved on to Greenland. So again, that's where a lot of the noise we're seeing right now. We don't hear a lot about Venezuela right now, and obviously what's happening over in the Middle East is a big driver as well. So time will tell. We'll see how it shakes out. But so far with the markets, it's digested it quite well. And like I said, I wouldn't anticipate it to be too negative at this stage based on what we're understanding. So let's have a look. Somebody just said to me, I have an individual that works at a bank. They said that beyond November this year, mortgage rates in Canada might rise. Maybe. I still think they have a little bit further to fall, to be honest. And mortgage rates aren't tied directly to interest rate policy. There's other things that influence mortgage rates here in Canada and the US. It's possible that they might rise at the end of the year. I don't know if that means interest rates will go up, to be honest. If our economy is sluggish, and then I think Bank of Canada will hold rates rather than increase rates. But we'll see. Hopefully inflation doesn't pick back up. If all of a sudden inflation picks up, labor market is strong, then it's possible that the Bank of Canada might have to increase rates. But I wouldn't expect that to be the case. We're seeing U.S. and Canadian labor markets soften, which is a good thing for interest rates. The only thing I would look at is if inflation rates picked up. And again, we're seeing that in the US, not so much here in Canada. So I don't know. I mean, things that far out, November, nobody knows. I mean, even the individual at a bank, they can forecast it, but so much can happen in a 10-month period. I would probably say it's more month to month than being able to look out 2 to 3 quarters from now. So, all right, perfect. Well, listen, guys, one last thing I would say. I'm going to likely send out a survey here in the next week or so. I would love your help with it. I want to get some feedback on the cadence of our sessions. Before we used to do these on a quarterly basis. Now we're doing them on a monthly basis, given what transpired in Q1 last year. I think we're going to likely revert back to potentially quarterly again, but I'm open-minded to your feedback. I will send it. I want to be mindful of the amount of information that's flowing into your inbox. I know for me, I like to, be a little more practical and have, good information coming in. So obviously we do weekly commentaries, which I think are helpful. We do these monthly sessions, which we might transition to quarterly. And then we're looking at doing a couple of other things that might come out on a weekly basis as well. So we'll send that out to you. It'll be a short, probably 5-question survey. If you can take a couple of minutes to just answer it, would be greatly appreciated. I'd love your feedback. So for the time being, like I said, I hope the balance of your January goes well. I can't believe we're 2 weeks left, 3 weeks left of January. It's already flying, but we're supposed to get some great weather here in the next couple days. So get out, enjoy it. If you have questions or comments, please don't hesitate to reach out and send me an email, and I'll try and get back to anybody that I didn't answer. If I know who it was that sent it, I'll try and get back with some comments. All the best. Have a great week, and we'll talk to you very soon. Take care. Bye now.